Let's start off with what the IMF has been saying.
Hello,
and some of the verbiages we've been seeing coming through when it comes to the naira. It seems that the IMF is alluding to the fact that the naira is overvalued, and depending on which model they use, it seems that it could be up to 15% overvalued, with as low as 2% overvalued. What do you make of those comments?
Well, Elena, this argument has been going on for a long time now, and we've had all the back and forth from CBN, from IMF, from different quarters. It depends on how you want to look at it. We here know that the naira is not overvalued. The IMF and other people overseas might be saying otherwise, but when you take into consideration local factors and other impacts of the exchange rate might have on other prices in the country, you begin to realize that it is necessary that naira is kept at about the same level it is today. The fundamentals may not seem so because the reserves are being depleted, but you don't just let other things go riot because you want to protect the reserve. And anyhow, the reserves are not at very low levels.
Well, Emeka, do you think that the Central Bank of Nigeria will be able to keep the naira in a tight target range, moving only 3% higher and lower within 2011? Do you think that it can sustain that momentum?
Yes, I believe so. The CBN is capable and willing to do that. 3% band is not very slim. We are talking about almost 5 naira, 4 naira, 50 kobo, 5 naira. On top of what naira is today. That even if that happens in one day, that's a huge level of devaluation and the market will react very, very aggressively to that. So when we say 3% plus or minus at the official CBN rate of today of almost 151 naira, if you're talking 3%, that's huge. You're talking about naira being more than 155 naira to $1. That on its own is actually a huge devaluation. So I believe that CBN will do everything, at least in the short term, to keep naira within that 3% band that they have promised, and which they have done very well at defending in the past 2-3 years.
Let's touch on bank reserves, and also when it comes to the CBN's monetary policy stance. What changes can we expect? We know that they have put some targets in place. Do you think that they can be met?
Well, CBN has expressed worries, at the inability of its monetary policies to achieve desired goals. They have looked at the system and they've identified that the transmission mechanism is weak, at best, maybe not effectual at all. And they have tricked with the way they manage the CRL. They want to put CRL management into the hands of banks. So from Wednesday, they're going to stop taking monies from bank accounts and putting in a sterilized account in CBN where they put the CRL. They're putting that in the hands of banks. So they close that account and credit banks with the CRL, and they expect you to now run your operations and make sure you're compliant. So it's all in line with the risk-based supervision being practiced by CBN more and more.
Yeah.
However, if that will achieve the desired goal, it depends on so many other things. And key among those is confidence in the market. Are you comfortable with the counterparties in the market? Because the new system is designed to encourage greater interbank placements. Yeah. If you have so much money in your account,
Emeka, if I could just interject there and just maybe touch on the overall monetary policy stance when it comes to interest rates. We've got a meeting in a couple of weeks' time. We've seen yields backing up materially from the first quarter of 2010 lows. They're still in negative real terms. What kind of impact is an interest rate hike in Nigeria, possible interest rate hike in Nigeria, going to have on the overall bond market and the yields?
So did you say the overall bond market, or you say overall market? Sorry, I didn't quite get that.
Bond market, Emeka.
Well, yeah, the MPC is going to meet in 2 weeks' time, and the expectation is that there's going to be much more tightening. We might see another 25-50 basis point tightening. It may not have so much impact on the bond market because that bond market already is, will I say, in a limbo. There are several issues around valuations and liquidity of the bond market, and banks are carrying potential huge profits that are not realized. So yes, if interest rates are taken up, yeah, it's expected that the bond market should react as much. But we might say that bank dealers may continue to be shy and see how things settle in that market before they take even longer positions in that market, because there are already huge positions that might translate to huge losses in that market. So it may not be a like-to-like effect.